I got asked a lot in the comment section of my video, what do you think about this company? What do you think about this company? So I decided in this video to analyze and to do a S-tier list of the companies that you put in the comment section to tell you if I like them, if I don't like them, what do I think about them. We look fast about the numbers. So S-tier will be very good companies that I think maybe it can be at a good price right now. A will be very good company, but maybe a bit overvalued right now. B would be a good company, okay? It's not like okay, it's good company. C would be okay company, but not that good. And D, bad company that I really don't like and see myself investing. Generally, I will see myself investing only in company in the A tier. Okay, so let's go. The first one is Capgemini. I think it's a French company. So Capgemini, let's see what are the numbers. So most of the numbers that I want to look, it's the growth of the company for the last years, the margins, okay, different margins, the return on capital, because it's important, and the financial health, so the debt. So for the growth, you had the EPS growing by 10% per year for the last 10 years, so which is pretty good, and a revenue growing by 7%. So it's kind of fine. Let's have a look how the company performed for the last 10 years. So kind of fine, okay? The margins, we have operating margin of 11%, free cash flow margin 10%. This is a bit low for me, okay? It's a bit low, especially IT services. It's a sector where I guess margins are supposed to be a bit higher, like 11% seems too low for me, okay? Return on capital, you have ROE of 16, 13, 9 here for return on capital employed 13, capital invested 9. It's again a bit low for me, so I will not consider it as an investment. To be honest, this is too low. The debt seems to be fine. Let's have a look at some ratio about the debt. Financial health, I want debt to EBITDA. And yeah, historically it's fine, it's under 3. So this I like, debt to equity 50%. It was a bit higher in 2020, but generally around 50%, so it's good. So the debt is not a problem. For me, the problem is mostly the operating margin. Even though margins, the operating one are getting higher, so this is a good sign, but they are a bit too low. They're a bit too low for now, so I don't really like this. And for the capital efficiency, the return on invested capital, this one is not really, it declined, okay? So I don't like this. Return on capital employed, let's check. And this one is getting higher, okay? So probably some accounting tricks, let's say. So this one is getting higher, it's fine. So this company, Capgemini, I will not, it's not a company where I would invest, so it cannot be A, okay? It's a good, fine company that it's not really good, it's not amazing, but it's not bad at all. Like, so I will put it in B. Meta, okay, Meta, it would be S or A because great numbers, great company. Like if you look at the numbers for Meta, you want to have an overview, you have like 36% EPS growth for the last 10 years. 29% per year for the revenues, it's great. You don't have really debt, 30% debt to equity, EBIT to interest expense, 95, so very good. When it's higher than 8, 10, it's good. Return on invested capital, 31, return on capital employed 28, 27 for return on equity, so great. Operating margin 41%, free cash flow margin 32%, so great. Like this is a great company. When it comes to the valuation, we'll just look fast where is the P ratio compared to the average that we could have for the last 10 years. And we're a bit under. The average was 28, we're at 22. The S&P 500 I think is around 25 here. So it seems that it could be a valuation which is fine. Let's have a look at the forward valuation. For the forward valuation, yeah, it seems that it's around the value which is historically fair. So now it depends how you see it for the future. I will put it here on A, great company. For me, it's not enough undervalued to enter, but it's keep to be still a great company. Accenture, I don't really know it. I think it's in Accenture PLC. I think it's incorporated in Ireland, if I'm not wrong in it. So here, IT service, and you see here, compared to Capgemini, for example, Accenture have a bit higher margin, 15% margin, which is nice. Way higher return on capital employed, invested capital, and return on asset. You have very low debt, so I like this. The net income, the EPS grew by 9.9% for the last 10 years, revenue by 8%. So we may see some increase in the margins. Let's have a look. Let's have a look at the margins, operating margins. Yes, they increased a bit during the last 10 years, which is nice things to see. For the capital efficiency, let's see the direction it took for the return on invested capital. It's going down. Okay, it's probably because they're getting bigger and bigger. At some point, it's going down. Not a big fan of the way it's going down. It almost got divided by 2, but could be worse. It's still higher than 15%, so it's still good. Are they doing some buybacks? Not really. Okay, they increased a bit here, then it decreased a little. There are very little buybacks, like 0.3%. So not really good. Do they have good future here? Yeah, 7% growth. Without buybacks, it's not really nice. And you have a low 2% dividend for already 46% payout ratio. It could be better. Okay, it could be better. It's not that bad, but I will put it. I think it's a little bit better than Capgemini, but same. It's not bad company, but it's not like really good company as well. Alibaba. Let's have a look here. Alibaba Group Holding. So here we have a company with a revenue that grew by 30% per year, EPS by 16% per year for the last 10 years. Okay, we had some trouble in the last 5 years, but now it's go back correctly. We have return on capital employed, invested, and so on around 6-8. This is a bit low, but operating margins are fine. We have low debt. It's a Chinese stock, so generally we have low debt here. The only problem I see here for this company is this capital efficiency. They are not really efficient with the capital. Okay, it's always been like this. I mean, it's not always been like this, but most of the time it's like this with this company because you have a big competition for this in China. I expect now the return on invested capital to continue its growth. For this company, it's a bit like Amazon. I expect to continue its growth because they are in the cloud. They are one of the cloud leader in China. So it's in the company that if you look just what's happening now, it's not fine, but since they're into cloud and they put their focus on this for the future, it's increasing. So here I put it between I could put it in S because it's pretty much undervalued, but it's a B+. For Alibaba, it's a B+. I have it in my portfolio because I believe it's really undervalued. It's a company that I think as well will improve in the future. That's why I have it in my portfolio. But if we see the numbers right now, it's a B. If you think that the number will grow in the future and will be better in the future, it's a S. So it depends how you want to put it here. It's either you see the future for it, so it's a S. Like you want to have an outlook on the future, so it's a S. But the future is uncertain. We don't know what will happen. It's only like, I think I have a 4 or 5% of my portfolio in Alibaba. So it's a small position. It's not a big one. So yeah, it's either B or S. I will keep it in B because we'll not see how the future will be. We cannot know this. So from what we know from the past, they could have been better with the way they use capital. For this company, this is Constellation Energy. Constellation Energy. I got it recently on my YouTube channel, which is, I think, electricity provider, but they have a nuclear capacity. So I guess the bet here is about the nuclear. The problem I see here is, first, the company was founded in 2021, so it's a bit too early for me to understand. Generally, I want a business to have at least 10 years of history, so very difficult here. The numbers are kind of fine. The operating margin is good. The return on capital employed, invested, and so on it's pretty much normal for the area, okay? For a utility service, it's pretty much normal, okay? The P ratio, it's a bit high, okay? Like, especially now, you can have some utilities with a P ratio less than 15. So I think people are a bit overpaying this one because of this, we don't have a good track. I think people are a bit overpaying this one. I have big hopes on this one because of the nuclear thing, okay? The fact that they are into nuclear and blah, blah, blah. I think it's something that people like. And yeah, but for now, the revenue for a new company increased only by 4.5%. I'm not a big fan of this, okay? Maybe I don't know enough about it, but I'm not a big fan. I'm also not a big fan that the dividend is only 0.7%. So the payout ratio is 11%. So it's very fine. They can triple it quite easily. But in the utility sector, it's historically utilities are not really a sector to outperform the market. So it's more a defensive sector. It should outperform when you have big uncertainty on the market or when you have a recession. It's mostly like a recession-proof area. So yeah, it's for me the valuation is a bit too high. You could have some utilities for 13, 14, which are more implemented. So yeah, this one is not bad, but it's in okay. Like I will put it as a C because it's not that bad. It's not really a bad company. Okay, now let's go with next one, BYD. BYD. I'm a bit biased here because I really don't like car dealerships, so it will be probably a C or a D, but let's have a look at numbers, okay? So for BYD, where do we have it? BYD Company Limited. We really have a great growth for the numbers here, so 29%, EPS 54%, so really good. And you saw it from the share price, okay? It's like, to be fair, it's probably one of the only Chinese stock now which is near a all-time high. Okay, so this say long. It's a company that managed to really get well in the world. You can see that the revenue, they have been exponential. They don't have this problem. It's because also they make great cars. Like they have good reputation for the cars. Do we have segment and KPI? You can see that they are managing, do we have revenue from, we have overseas revenue. They manage to sell, okay, in other countries and not only in China. They manage to export the car. So this is probably where they're good. They make great cars, okay. I heard people having those cars really like them. So yeah, I think in terms of a car company, it's a good one. Now, with all the electric vehicle hype, will it last? I don't know. I don't know all of this. I don't know if the electric vehicle things and so on will last. I have absolutely no idea. But you have return on capital employed, return on equity and return on invested capital, which are fine, okay? Return on invested capital is a bit low, but when you see the two other, it's kind of fine. Operating margin, 6% is normal for a car dealership. Like for a car, it's really normal. So you don't have particularly bad things here. I feel the valuation is a bit high, especially for a Chinese stock. To be honest, like you have, like, yeah, valuation is pretty high for a Chinese stock. I will not invest in a Chinese stock with a PE higher than 20, to be honest. So I find it a bit overvalued. The numbers are fine. Like, to be honest, for car companies, probably one of the best one, but I don't invest in car company. I don't like this. So I will put C because other car company will probably go in D. But yeah, I just don't like the margins. I just think they are better compared to the other car companies. I think they are better, but I don't see the point in investing in a company like this because now they're in a growth phase. When the growth phase is finished, it will be probably very cyclical. So now you're at the high of a cycle, so I will not invest in this. Tencent, one of the Chinese giant as well. Tencent Holding. Here you have a P of 21, okay, forward P is 16, which is pretty good. EPS grew by 23% per year, revenue by 23% per year, so they didn't improve their margin apparently. Return on equity, capital employed around equity 20, capital employed 12, 9 for return on invested capital, operating margin 31%, which is good. Debt to equity 30%, like the debt is well covered. Let's have a look at the revenue. Yeah, I want to see the operating margins. Yeah, they were decreasing, and since 2022 they're increasing back. Okay, so the number I kind of find. Let's have a look at the way it evolved for the return on invested capital, because I feel that they don't really have a nice efficiency. It's decreasing, okay, and now getting back up. So here I don't know enough the company because I didn't invest in it, but it's a bit like Baba. If you think the number will increase, especially the return on capital employed will increase, it will be a S. But for now, they have good numbers, not amazing, but good numbers. Like they have great margins, but it has been a bit declining. So if you think they're on a way to increase their return on capital employed and increase their margins, it could be a S. Okay, the valuation seems kind of fine, kind of fair. It could be a S, but same, I will put it as a B. Good company. Eli and Lilly. Eli and Lilly, let's have a look. So for Eli and Lilly, I may be biased because I'm invested in Novo Nordisk, but revenue grew by 8% per year for the last 10 years, but we have an acceleration 15% and 3% for the last 5 and 3 years, okay? EPS 18% for the last 10 years, so they probably increase their margins. Let's have a look at the operating margins. Yeah, operating margin have been increasing from 18% to 38%, so it's more than double, really good. Let's have a look. The average 5 years for this. Return on capital employed 28%. Return on capital invested capital 22%. This is good. Debt to equity 240%. This I don't like. Let's have a look. Where it is. Financial health. Debt to equity. Yeah, it just got higher now. Before it was less. But it can be also the equities that change too fast. So let's mostly look at the debt to EBITDA. Debt to EBITDA 1.6, which is good. EBIT to interest expense 22, which is very good. Return on invested capital, it's getting higher, so it's good. Capital employed, it's getting higher, so it's good. So yeah, it's a very good company. Compared to Novo Nordisk, here you have way different, you have way more area, okay? They have oncology, immunology, neuroscience, and other products, while for Novo Nordisk is mostly diabetes and obesity. Here you have a big, it's a very big company, okay, way bigger and more diversified. The problem that I see with Novo Nordisk, with Eli and Lilly, is the P ratio. Like the P ratio is super high. Let's skip 2017. And you have 75 PE ratio, okay? I'm not comfortable investing in company higher than 30 PE ratio, especially when you have Novo Nordisk trading like now at 15 or 16 PE ratio. Even the forward PE ratio, okay, we can look at the forward, we can say, okay, yeah, but the forward is only 39, but yeah, 39 is too high, it's way too high. I need it to be under 30 to consider it maybe as an investment, but doesn't change the fact that it's a great company with great numbers. So if you're comfortable investing in pharmaceuticals, yeah, I would put it a A. It's a great company. Carlisle, I don't know this one. It's first time. Carlisle company, what do they do? Operate a different manufacturer and engineered products. Okay. So revenue grew by 4% for the last 10 years. Not really good. EPS 10%, so probably great increase of margins. Okay, we have some increase of margin, which is good. Now it's 21%, operating margin well, and probably some buybacks to grow like this. Yeah, some solid buybacks, 3.9% for the last 10 years, and for the last 5 years, 4%. Yeah, solid buybacks. This I like. Just problematic, the growth was a bit slow. The EPS growth was good. So the revenue is planned to grow kind of fine here. 21 PE, okay. Operating margin 21%, return on capital 13%, 16%. Let's look at how it evolved. Okay, this one is growing. It's growing, it's kind of well. Like, yeah, it seems that they're improving well with time. Let's see with capital employed. Okay, it's a bit unstable and it grew lastly. So yeah, it seemed to be fine. I need to look a bit more into it. Let's have a look fast at the valuation. Okay, valuation, maybe it's around the fair value. Historically, in terms of PE, it's around what it was. So probably you need to invest in here when it's under 20. When it's under 20, you may have some opportunities, especially if they continue to do those buybacks and continue to increase their margins. So yeah, it can be a nice company. Let's have a look at how the price evolves. Yeah, minus 20%, 22 when everything got down, minus 30, a bit like S&P 500, and 27, 28, minus 55. But it got back to the price 4 years after, 4 years after. Okay, it was 47, and yeah, 4 years after, you got back to the all-time high after this big one. So yeah, it's good that they do those buybacks. It seems that they are competent. Let's see if the ownership, Christian Koch, on 0.5% of the company. Okay. So yeah, it's interesting company. You have some nice things. It reminds me a bit like company like O'Reilly or AutoZone that are not growing big every year, it's like 6% per year, but they do so much buybacks and their margin are increasing that they are growing the EPS by more than 10% per year. Okay, so we have the bit same scenario here. So I kind of like it. It's a A or a B. I will put it in A because I like the fact that they do buybacks and so on. I will put it in A, but after it may be a B. Okay, it's between B and A. The reason I put it in A is because it seems that they're growing their EPS good, and on the long run, what matters is the way the EPS grow. So this is good. They do buybacks. So I don't know this business particularly. I never heard of it. I never studied it. So I need to study it a bit more to really keep it as an AA. So that's why it's between B and A. Okay. I leave it at A here because I don't know it, but yeah, it's between B and A. You need to study a bit more. Remitly, I don't know how you pronounce it. I think it's something like a payment thing to send money somewhere, a bit like, what is this thing that we have everywhere? Western Union, I think it's something similar. Immigrant and family, yeah, it's like Western Union. Yeah, the growth is not nice. Company was founded in 2011, probably IPO'd here. EPS, okay, revenue 58, so they probably did some shareholder dilution. Yeah, they issue new stock, so I don't like this. Yeah, operating bad. Oh, yeah, I'm sorry, but this kind of business I don't like. I think it would be in D, the first D of the day, because I don't see the moat for this kind of business. Okay, they just transfer money from a country to a country. You have Western Union doing this. You can do it now with PayPal banks, with cryptocurrency, with so many different ways. So I don't know what are they doing differently from Western Union. They're also a bit too young, and they don't have good numbers for now. They're diluting shareholder. I will not play to invest. Okay, especially you pay 23 times the future earning. So no, I don't like this. I don't like this at all. We can have a look fast at the operating margins. Gross profit margin 59%. Okay, fine. Operating margin minus 3%. Western Union, is there? Let's see the gross margin for Western Union, 37. So they have better gross margin, but yet operating margin for Western Union is 18%. So yeah, I keep it in D. Li Auto, Chinese auto, I guess. So you see very cyclical for the last 5 years. Was founded in 2015. Revenue totally skyrocket. EPS skyrocket. You don't have really nice return, but it's the last 5 years. So if we look at closer to now, 13, 24%, 13%, fine. A return on equity 22, 12, fine. Capital employed 11, 8, a bit low. It's kind of fine here. Margins, operating margin, normal one, a bit low here, but they are kind of normal for the auto industry. So gross profit margin are a bit high, so this is good. Seems that they are not a bad automaker, but yet again, they are an automaker. It's something which is very cyclical. So I would put it as a C. It's not a bad automaker, okay? You have way worse, but I will not consider investing in it. Rocket Lab USA, I think it's Rocket Lab USA. What do they do? A space company for a launch service and space system solution for the space and defense industry. Okay, so it skyrocketed in 2024, like all the defense thing, like they really skyrocketed. Okay, they IPO'd in 2021. They have a P ratio of minus, so they are not profitable yet. So, yep, if they are not, gross profit margin 26%. Okay, net income, yeah, they are not profitable, so it's automatically. Rocket Lab here, a D, because I don't invest in non-profitable company. I don't take this risk. You have so many great companies which are trading at some nice value and so on. So why bothering with trying to find something which is not profitable and maybe will be profitable in the future? Like the odds are really not in your favor when you do this. So you might think that, oh yeah, but if it works, I will 100x my capital. Yeah, the odds are really not in your favor when you do this. Let's have a look at Honda. Honda, Japanese car maker. I think it's this one, the main one. So for Honda, gross profit margin 21%, really good for a car maker. Operating 6.6, yeah, which is normal. EPS grew by 7% for the last 10 years. I don't really like it, even though now it's accelerating. Revenue 5%, 6%, don't like it. They have a high dividend yield, okay, which can be fine. Return on capital, not really good for the last 5 years. Yeah, this one, same. I don't like. I don't really like. When you look at the revenue, it's very cyclical, not really increasing. So we may see less increase and cyclicality here. So I don't like this. Again, it's not a bad one. So yeah, it's between C and D. Like all the auto cars, it's between C and D. TSMC, Taiwan Semiconductor, which is a great moat business in the sense that they have the knowledge to build everything in the semiconductor industry. So this is really good. You have really good return here on capital, so that's great. Margins, great, okay. The EPS grew by 16% per year. It's planned to go by 20% per year. Revenue by 14%, so they increase their margins apparently as well. Yeah, operating margin have been increasing. Do they do some buybacks? No, they don't do buybacks. They don't do buyback yet. But it's not really problematic when you have this kind of growth. Let's have a look at the debt, but I think they don't really have debt. Yeah, net debt to EBITDA negative. Okay, 20% debt to equity. Really good. It's really good. Let's see the valuation now. The only problem here is probably the fact that same than all the semiconductor thing, probably a lot coming from Taiwan and around China. Even though you have United States, which is bigger, but is it from the United States factories or United States clients? This is something different. Because if most of the factories, I don't know it enough, I didn't study it enough, but if most of the factories are in Taiwan, it may be problematic about geopolitics. Let's see the value, the PE ratio. Yeah, the PE ratio is 106, so it's definitely too much for me. But let's see the forward PE. 17. Okay, 17. How come the PE ratio is so different? Yeah, okay. 17 as a forward PE, which is kind of fine. It's not the lowest that they had, but it's not, I think it's around the fair value. I think it's a great company around the fair value now. So I will put it an A. It's a solid A. Good company. They have a very serious moat, like really serious moat, big moat. Yeah, it deserves an A. Okay, if you price decrease, it could deserve S as well. Only problem here is the geopolitics. If we have a big tension between China and US and something happen in Taiwan, this can be problematic. But they are building factories in the US, in Europe, I think as well. So it will help for the future. So I'm not worried about them. I will just put them as a A. Next one is AMD. AMD. Advanced Micro Device. So let's have a look. So EPS grew by 6% per year for the last 10 years. Revenue 16%. So they didn't increase their margin apparently, or they diluted shareholders. Let's have a look. Operating margins, yep, not really good. Net income, okay, they started to be profitable only since 2018. Then they had a big spike, now down back, and then they're going up a bit. Okay, I think this company, like, it's a really, I call it a fanboy company. Like, it's a bit like Tesla. People investing in AMD generally, they're a bit fanboys for this thing. Like, they are, oh yeah, the new CEO is amazing, like PayPal. Like, the new CEO is amazing, it will change, it will revolutionize it and so on. So we have some good results for now, but yet it's a company that I guess is not doing buybacks. Yeah, no buybacks at all. So yeah, as you diluted shareholders, you don't have a very good track record in history. Okay, when you look at the EPS for the last 10 years, the track record is not really good. Okay, so just for this, I put it as a D. As a D. Now, if you believe this company will be good in the future, you can put it as a C. And then probably in 5 years as a B. But for now, with what we have, for me it's a D. I don't like this company. I don't see the moat yet in this company. In my opinion, Nvidia are way, way, way better. Even though Nvidia, I'm not a big fan, but they are way better. So yes, they have a good growth perspective. Okay, 21 PE, like forward PE can be fine. Yeah, but no, I would not. For me, I cannot invest now. In 5 years, maybe when they will have a track record a bit more serious, why not? But for now, with the track record they have, I don't really like it. Especially that semiconductor industry is a bit cyclical. So yeah, okay, you're in a down of a cycle, but you have so many other opportunities that I think can outperform advanced micro devices. So I put it in D. Qualys. Qualys, I think it's security, right? It's cyber security. Qualys, revenue go by 16%, EPS 19%, really good. You have return on capital, which are very good as well. Operating margin good. P ratio seems to be around kind of fine. Okay, let's see, operating margin, did they grow? They grew their operating margin. Are they doing some buybacks? Yep, I mean, they start to do since here 1.8% per year, which is kind of fine. Let's have a look at ratio about the financial health. The debt, how is the debt? Debt to equity, fine. Debt to EBITDA, great. This company can be interesting. Growing margins, which is something really good. Okay, let's see the ownership. Okay, no, it's not really, you don't really have a lot of insiders owning this company. So why did it, like, it with such great company, why numbers don't seem that it outperformed the S&P 500? Yeah, the S&P 500 did way better than them, while they grew by 16% per year in revenue and 19% in EPS for the last 10 years. So what is the problem with this company? It seems that they don't plan to have any growth for the future. This is not really nice. I'm a bit worried about this growth, so that's why I put it in B. It's a good company, not great company, because the growth seems to be unsure. Like, it really seems to be unsure. You need to deep dive into it to understand more why it's like this. But for now, I put it in B. If you deep dive into it and you think it's should be better. Go ahead, it may be an A, but for now I put it in B. Nvidia. Nvidia, we cannot really talk about it, like really steady growth, like 59% per year, 39% per year in revenue. They increase their margin, return on capital, amazing. Margins are amazing. Like the company really improved like so fast lately. It was always a good company, okay, but it really increased like kind of fast lately. I don't think they do buybacks. Do they do buybacks? Where is it? Total share outstanding. No, they don't do buybacks. They started this year, maybe a first buyback from 2024 to by 2025. Yeah, maybe they will continue. No buyback yet, but nothing big to say about this company. It's a great company. I would put it in. It's okay for me. It's either a A or either a D. I cannot put it a D because I'm not sure about Nvidia's moat. Like I don't understand Nvidia's moat. Okay, like AMD, I don't understand their moat. But the history that Nvidia have shows that they manage well. Okay, they are well managed. They can grow. So I put Nvidia as an A, but it's A that I will not invest in this company. Okay, it's not a company that I see myself investing in it because I don't understand the moat enough. But yet they are really good. Okay. Toyota. Let's have a look. Toyota increased EPS by 11%, revenue by 5.6%, so probably the margin are getting higher. Operating margin of 10%, which is really good for a car dealership. Okay. Return on capital, which is a bit low, kind of fine. 3% dividend. Debt seems to be well maintained. Let's have a look. Debt to EBITDA, which is 3.9. It's a bit high. Okay, the debt to EBITDA is a bit high. Yeah, Toyota, I will put it same as a C. It's fine, okay, but I will not invest. I will not invest even if it's a good car dealership company. Like for me, the only car, like not dealership, but the car company I could invest would be a Ferrari, okay, but because they are like a luxurious car and they don't depend on how the economy is doing. They depend on if people want a Ferrari, and people want a Ferrari. Novo Nordisk. So Novo Nordisk, I put it as S. Okay, it's a company that I have in my portfolio, so I may be biased on this, but you really have a great company. That the revenue grew by 12% per year for the last 10 years, EPS by 16% per year. Okay. You have a company which is supposed to grow by 16% per year. You have a P ratio of 18. Okay, if you look at the history of P ratio for this company, 18 is probably the lower since 2016. Okay, so yeah, really, really good. Operating margin 48%, return on capital and so on 29%, really good. Let's have a look at the margin, how the margin evolved. You have operating margins that are growing as well. So yeah, great business, great company. I think they are really good. I think for me they are S. Okay, so it's now one of the biggest opportunity on the market. Like if you are comfortable, of course, investing in this kind of company, in pharmaceutical. That in terms of numbers, okay, they are kind of same than Lilly. Lilly is more diversified, but Novo have a very, very good advantage in diabetic, okay. In weight loss, maybe less, okay, but because it will be more concurrential. But for the price that they have now, yeah, it's a S. Amazon will probably be a S as well. My opinion is undervalued. The thing with Amazon is a bit same than Baba. You need to look at how it will look in the future because they're increasing their return, okay. Because before it was mostly like Amazon Marketplace, not very profitable. But lately, you can see that the profitability have really getting higher. It got higher thanks to AWS, the advertisement service that they have, the Prime membership, and so on. So it's a company really, really growing correctly. In my opinion, but this, again, I may be biased because it's my biggest position in my portfolio. It should be the biggest company in the world. In terms of market cap, they should be before Microsoft and Apple. But yet, maybe I'm biased when I say this. When you look at the return on invested capital, like it's growing, okay? It's growing correctly. It's almost higher than 15% now. So yeah, Amazon, in my opinion, under $220, it's undervalued. So I put it as a S. Google, it will go as well as a S. Do I need to explain again everything about Google? But you have great numbers. Like EPS grew by 24% per year. Revenue by 18% per year. You have high return on capital, around 30%. Operating margin around 30% as well. And you can see that they're increasing. They're improving all of this. So yeah, Google for now, when you look at the valuation, it's a company that you can buy for almost a P ratio of 20, something like this. Let's have a look. Yeah, you have a P ratio of 18. 18 for such a great company. So yeah, everybody is using Google every day. So Google is a S. ASML, S as well. I don't have it in my portfolio. I have a different company in the semiconductor industry in my portfolio. But ASML, they have huge monopoly, probably a huge as well moat because they're the only one able to make those lithography machines. So yeah, ASML is good. They're growing very well as well. When you look at the overview, EPS by 19% per year, revenue 17% per year, high return on capital employed, invested, and so on, high margins, okay? You pay a premium on it, let's be fair, you pay a premium on it, but in my opinion, under $600, it can be fine if you think you will continue to have this premium on the valuation in the company. If you don't think you will continue to have a premium, then maybe 550 should be a fair value. But if you still think they will have a premium, think around 20, like the, how do we say, the PU should stay around 25 to keep this premium. So yeah, I put it as a S. I think now it's undervalued. Constellation Software. Constellation Software. Like a great compounder, 21% per year for the EPS, 19% per year for the revenue, okay? Return on capital employed 26, 29 here, margin 14%, okay? Do they do some buybacks? Not really, okay? They mostly buy business with this. Gross profit margin is very stable. Operating margins stable as well. Didn't increase, didn't decrease. It's very stable. Let's have a look at the ratios. Capital efficiency, return on capital invested. This one is a bit low, but when you look at capital employed and equity, it's way higher. It's decreasing a bit. So this one, I think the problem that they have is that you don't really have a lot of things that they can buy. Okay, they buy software company and they make money with this, but they're growing, they're so big that it starts to be difficult to continue to have this. So this one, it's an amazing company. I will put it as an A. Is not cheap, okay, 100 PE, 37 forward PE. I think this one could be interesting to invest if you like the business and you like the idea here. When you have a forward PE, which will be, yeah, they had under 30. You need to be under 30. I will even put under 25. Like if you can be under 25, 28, it can be a good moment to enter this position and this company. Mastercard, solid A. Okay, everybody know Mastercard, I guess. Mastercard is a solid A. They do buybacks. Okay, you have return on capital, amazing. Margins, amazing. Revenue grew by 11%. EPS 16% because they do some buybacks probably. Yeah, you have great margins. Yeah, great buybacks. This company is very solid, very stable. Okay, you can see that. Yeah, it grew from like very stable area. In 2020, you had an amazing opportunity to enter here. 2022 as well. You had a great opportunity to enter. Yeah, this one, it's a bit expensive. I would like to have it under a forward P of 30. It's possible to have it under a forward P of 30. This doesn't happen like a lot, but it's possible, okay? You take it, you could have it like, yeah, almost a few days ago, a few weeks ago, you could have it. And generally, yeah, I wanted to have under a P of 30. If the company go under 30, I will probably buy it. It's probably a company that I will buy. So it's going A. And for now, it's not an S, but it could be. PayPal. This one I will be biased because I use PayPal and I hate it. Like, I really hate this company. Like, with the deepest of my soul, I hate it. But sometimes I don't have any choice because my customer want to pay with PayPal. So, like, I think I want more the money from my customers, for my services and so on, that I hate PayPal. But yet, it's a company that grew by EPS by 27% per year. Revenue by 14% per year, but yet it didn't really explode. It's doing very bad since 2021, minus 80% almost. So I think it's really undervalued. Like, let's be fair, it's undervalued. There is no debate on it. The thing I don't like with PayPal is I don't see any moat with this company. Okay, for me the moat is not here. When you look at they plan to do big shareouts, like big buybacks. So this is really good. Like, I think they plan like 10% buybacks for this year or next year. So this is really good. What else? It's problematic. The operating margin are not moving. Okay, up, down, up, down. Now they're increasing a bit more, but not really good. The thing I don't like as well is when you look at this, you don't really have a lot of new accounts. Okay, since 2021, it's pretty flat. This is not really nice for this kind of business, but they will probably improve their operating abilities and so on to continue to grow. But at some point, if they don't have new active users, it may be problematic. So this is what I don't like. The numbers are great. All of this is great. So it's a good company. Okay, I would put it as a B. It's a good company, but for me, they lack too much of a moat. And like, really, like, I don't know for you, for people who have a business here and that they use PayPal for service, like, I pay at least 12% fees from when the customer pay me. Then I need to, because I'm paid in euros, so I need to convert it in USD because my company is in USA. So I need to convert it in USD. So I have 6% fee on this, then 3% to convert in USD. Then from USD, if I want to transfer to my bank account, I have 3% fees again. Okay, so it's way too much fees for what it is. Unfortunately, sometimes I don't have choice to use it. So yeah, this is my this is the S tier, the tier list. Let me know what you think about it in comment. Let me know as well if you would like another episode like this. If it's the case, give me some other name in the comment section. It would be nice. It was fun to do this. I discovered some new company like Carlisle. Didn't know this company, so it's nice to discover a company like this. So yeah, let me know in the comment section what other company would you like for episode 2 or 3. And it will be very nice to do it again. Bye-bye.